Welcome back, everyone. We now have the second keynote address of this conference, which will be given by Jonathan Haskell. Jonathan doesn't really need much introduction to this group. He has carried out much influential research on intangibles for many years. He's written books about the topic. He has worked with the statistical agencies, including the Office for National Statistics, in carrying out these analyses. He has also joined the Monetary Policy Committee. He's a member of the Monetary Policy Committee, a policymaker. So a very, very long list of things we could say, and we're very, very delighted to have you here, Jonathan.
Thank you very much indeed, Rebecca. And thank you all very much for coming. Before I start, I'm going to make two very quick announcements, if I may. The first thing is, as Rebecca kindly says, I have the great privilege to be on the Bank of England Monetary Policy Committee, and I can tell you with some good news, which is I'm not going to be talking about monetary policy. I'm making a speech in a week and a half's time, which colleagues from the ONS are very kindly helping me on. So I have nothing at all to say about the conjuncture of monetary policy and this and the other. That's all going to have to wait for a week and a half. That's the first thing I wanted to say. Now, the second thing I wanted to say is, as we're towards the end of the conference, I want to say a big thank you to everybody to make sure that you all we all acknowledge the people who've worked so hard on this. Rebecca Riley, who's there, Mercy Quaino, where is Mercy? There she is over there. Andrew Sharp, who is sitting over there, and Mary O'Mahony, who is sitting over there as well. So can we thank all of them? Actually, why don't we just do all of that? Okay, so let me get to the meat of what I wanted to say. Rebecca, so sorry, do I have a clicker, or they'll people who advance the slides for me? Oh, thank you very much. So something about intangibles, something about productivity, that's a source of a lot of interest for people here. And as I say, the policy is not going to be the detailed, meeting by meeting stuff about monetary policy, but the general milieu of policy. And I'll end up by saying how useful I think intangibles has been in the current job, which I have the honor to have. So let me just press this button and see what happens. Fantastic. So we're living in an increasingly intangible economy. Here's a picture on the left that is in Stian Westlake's and I book, and it builds on Dan Sickles' picture taken from the Intanvest website. The intangible investment is in the blue, the tangible investment is in the red. As Dan said yesterday, and as he documented in the Corrado Holton Sickle paper, intangible investment is zooming ahead. A picture on the right is a book that Stian Westlake is a graph that Stian Westlake and I are very fond of, and this is from this terrific book by Baruch Lev, who's a professor of accounting at NYU and is co-author Fen Gu. And I think we should all acknowledge Baruch Lev's fantastic work in this area. And essentially what you can see is those declining blue curves tell you the R squared of a regression, where you take firms in the US S&P 500, I think it is, in the 1950s, and you regress their market value on their book value, and you get a pretty good fit. Then you go over to the far right and you take firms in the 2000s and you regress their market value on their book value, and you get a terrible fit. And everybody will know in this room the reason for that, of course, is those firms are very intangible intensive. That is not on the books. And so guess what? As Baruch Lev has been at pains to say for many years, we don't really know when we go to their company accounts much about what they're doing on the intangible side. So that's part of the background with which people will be familiar. Second background is, of course, the productivity slowdown. So the dotted lines tell you for the US and the UK and for the Eurozone what productivity would have been, and then the solid lines tell you what it actually has. So we've had this horrible productivity slowdown as well. Chris Giles from the FT is sitting in the front here, and he and others have written very eloquently about how this is incredibly important to what it is that we're doing. Now, the other thing on a more financial side is a fall in what is called on the monetary policy side R star. So you think of R star as being the natural equilibrium rate of interest, and what information do we get from this picture here? Well, what we see on the lower two lines on the lower two lines, I'm just seeing if I've got a pointer here, but I don't. On the lower two lines, I'm going to point with my hand. On the lower two lines down here, that's the yield that you would get if you invest into essentially some safe assets. So think of those as being government assets. And that's been falling over time. And therefore, central banks have been somewhat boxed in by the fact that because the natural rate of interest has been falling, central banks have had to follow that interest rate as well. The upper line is another measure of yield, and that's the rate of return that you would get if you invested in the aggregate economy. Actually, that's the Hall-Jorgensen rate of return that falls out as a residual once you crank the handle on the value added and the capital and so forth. So it's the rate of return that falls out as a residual, which means that all the payments to capital, including intangible capital, would exhaust the profit rate, gross operating surplus in the economy. And you can see that well, it's remained flat more or less. And the red arrow between the two tells you that the spread between those things has been going up, and lots of people are puzzled about why that spread has changed. Another phenomena of the economy is taken by a recent, I thought, very interesting paper by Della Riccia et al., which I'll come back to. They have very detailed loan level information from the US about the type of loans that US commercial banks are making. Now, there are a number of lines here, so let me just walk you through the lines. The red dotted line tells you that commercial and industrial loans are falling. So the data starts in 1977 and goes up to 2010. So the amount, as a percentage of all loans, commercial and industrial loans in US banks are falling. What's the climbing line? The blue climbing line, you'd think that's loans to intangibles, right? We're all in an intangibles conference. That must be loans to intangibles. No, it isn't. That's loans to real estate. So what's going on in the US is the loans to the real estate are filling up banks, and commercial and industrial loans are going down at the same time. That's the final black line is a measure of intangibles. Another piece of research which I've been trying to digest is this issue about the flattening Phillips curve. Dan Sickle, in his talk in the second of his menu of topics, mentioned the flattening of the Phillips curve, so that hopefully relates to what Dan was saying. So this is a regression here for the United States of an exercise where you take an output gap measure and you take an inflation gap measure, the gap between inflation and its target, and you ask the question, what's the correlation between those two things in the 1990s, which is the red line? You get a strong correlation, and then that correlation seems to have flattened out in the post-financial crisis, and that's the blue line there. So some of these macro trends, what can we see? Productivity post the GFC slowdown, there's a post-GFC slowdown, gaps between the low firms and the high firms. So Alex Himbert gave a talk a little bit earlier on, discussed by Anthony Sfaga, who's sitting in the front row there, about those different gaps. The fall in R star, and this rising spread over R star as well, the flatter Phillips curve, and the increasing intangible investment, but a slowdown after the global financial crisis. Now, we've got a number of macro stories which explain all of that. So here are a few of them up on the slide for you. The first is something to do with product market power. Something's gone wrong with the antitrust authorities, who are asleep at the wheel, and product market power has been, increasing, and it's all essentially the fault of those antitrust authorities who should know better. Once we've got a lot of product market power, investment slows down. We know from basic economics that output is pulled back because that's what firms with product market power do, and all these various other things, various other difficulties ensue. That's one sort of story. The other sort of story is about a high demand for savings and the globalization of the savings market and so forth, lowering our star. Larry Summers and various others have been talking about that. And then the other story, similar globalization story, is that globalization somehow flattens the Phillips curve. Maybe there's more competition going on. Maybe it's harder for firms to achieve markups and so forth. So I asked the question at the bottom here, what's the role for intangibles in these macro trends? And as I don't need to tell everybody at this conference, intangibles explains everything, of course. I don't think it explains absolutely everything, but I think it's a part of all these various pictures. So what I wanted to do, Rebecca, is to take people through the various bits of intangibles, which I think help explain some of these puzzles. and then end with saying something about intangibles and COVID. So what's the role of intangibles in all of this? Well, the first thing is the measurement feature of intangibles, which again, everybody in this audience knows, very hard to measure, often particularly omitted in company accounts. And that might give you an apparent rise in markups. That's a sort of first issue. And then the second feature follows from the economic properties of intangibles that Stian and I tried to talk about in our book. And a couple of those properties are up on the screen there for you. The first is spillovers in a knowledge good likely will spill over. And so if intangibles slow, then TFP, to the extent that TFP is driven by spillovers, TFP slows as well. The second up on the screen there for you is scale, to the extent that firms can scale up over all of these intangibles, the growing firms, the firms who are getting bigger, they scale up and that leaves the laggards behind. And there may be something to do with the flattening, the Phillips curves as well. So firms don't feel when they get an increase in their demand for their output, they don't have to immediately push up wages. They can kind of go down their falling average cost curves and scale up over the intangibles they're using. And the third thing is around these issues of sunk costs and synergies. Sunk costs mean it's very difficult to get external financing for intangibles. So we might have an inadequate financial system, which means that there's less investment in intangibles than we would think. And then I'm going to talk a little bit about how that might change these spreads and therefore something about the responsiveness to monetary policy. So let me start with slowing intangible investment. There's a little graph here put together from the Intaninvest dataset. And what that shows you essentially is the following. If you use the investment data to build up some capital stocks and draw a trend before the financial crisis, you get that blue dotted line. And what do you find? You find that after the financial crisis, the pace of intangible investment has slowed. Now, I'm doing it on a log scale, so there's a lot of eyeball econometrics going on here, and you'll rightly be horrified at the fact that we don't want to just be doing eyeball econometrics, we want to be doing something more formal than that. But there is at least a suggestion that there might be an issue there. And this cross-country graph here tells you the following. So let me tell you each point. So each point is the change in TFP on the vertical, and on the horizontal is the change in intangible capital. If we think there are spillovers, that growth in intangible capital spills over to the TFP. And up on the top right, those points there are pre-financial crisis. So that's a cluster of points. Before the financial crisis, lots of intangible investment and lots of TFP going on. Over on the left-hand side, after the financial crisis, big fall in TFP, again, as I noted earlier on, and a big fall in intangible investment as well. So again, eyeball econometrics, there's a rough correlation between those two, suggesting the countries with the biggest falls of intangible investment have had the biggest falls in TFP. So I think that's some potential angles on the TFP side. Let me come to this slide here, dangerously entitled Monetary Policy in an Intangible Economy. Again, nothing about the current conjecture, just about how, on the monetary policy side, how I think thinking about these intangibles might be rather helpful in broader, standing back from the types of policies we're trying to do. And I asked the question at the top there, if the economy is increasingly intangible intensive, how does that affect monetary policy to the extent that monetary policy is intangible targeting? So the framework I'm going to use is the ISMPPC, Phillips Curve kind of framework. So again, apologies to the non-economists in the room, but let me try and tell you a little bit about how that works. What that works is that says interest rates affect aggregate demand through investment and savings. That's the IS bit. The monetary policy authority reacts in a certain way owing to its various targets, so it tightens when inflation goes up and so forth. That's the MP bit. And the Phillips curve is a Phillips curve bit, which says if you pump up the economy too strongly, then you get too much inflation. And so the transmission mechanism in that framework from changes in the interest rate, which is the control variable for the monetary authorities, to changes in investment and consumption, then work in the following way. So the first thing is, it's possible that there was increased sensitivity of interest rates, increased sensitivity of investment and consumption to changes in interest rates. So this is the slope of the IS curve for those of you who are at Larry Summers's talk on secular stagnation on Wednesday. So there's some evidence, the evidence goes different ways, but there's some evidence, as I'll show you in a second, which suggests that that might be the case. The second is that housing might become more important. As we've just seen, there's been this transfer over from lending to firms to lending to housing. So that's on the kind of investment saving aggregate demand side. And then over on the Phillips curve side, if you flatten out the Phillips curve, as I mentioned, because firms might be able to scale up more easily. And so what that gives you essentially, and again, forgive me, this is kind of diagram speak, but if you think of that kind of apparatus, a flat Phillips curve and a flat ISMP curve give you a situation in which the economy gets kind of stuck at low inflation, right? There's not much, the monetary authority can try and do stuff, but that just moves output. It doesn't move inflation very much. The Phillips curve is very flat, so inflation isn't reacting. And so inflation is kind of quite sticky. So pre-financial crisis, that would be a story, unless there's a huge shock, as there has been over COVID. So just to get into the little bit of detail of all of that, I find the paper by Steve Oliner and Glenn Broiderbush very helpful here, which sets out some of these types of issues. So I've set this up in the slide here underneath this notion of a credit channel or a financial accelerator as a shock amplifier. So before we go to intangibles, the kind of credit channel financial accelerator model says the following. It says, suppose you've got a firm who generates some internal funds. So that's the horizontal bit, and the internal funds, it's got F internal funds. If it wants to borrow against those internal funds, it can do so at an interest rate, or rather it worries about the opportunity cost of those funds. And so if the interest rate starts at R0 and then is lowered, then the cost of those funds goes down. The firms then go down their demand curve. This is the demand for investment. And that's because the marginal project is getting more worthwhile. So a cut in interest rates raises investment by firms, as I say, by improving the marginal project of the firm. That's one mechanism. The accelerator mechanism works like this. Once the firm has got to the end of their internal funds, so that's the kind of green bar, there, if I focus on the upper red line, they've got to go out and borrow. And the price of going out and borrow goes up as the firms borrows more and more and more. So its balance sheet is, banks look at the balance sheet, they look at the fact that there's more and more borrowing going on, and they charge the firm accordingly more for that case. So the internal funds is flat. Once they go out and borrow, they face that high amount. So what now happens when the monetary authorities cut rates? So the line goes down, as I've just said, and you might imagine, therefore, the line goes from S to S1 because it also gets cheaper to borrow these external funds. So the financial accelerator idea is that the line then cranks around from S1 prime. Sorry, I should have said down from S1 to S1 prime. The line cranks around from S1 prime down to S1. That is to say, at a lower interest rate, the balance sheet's constraints that firms face are getting a bit easier. So think of it, for example, when a firm borrows, it often has to sign restrictive loan covenants. So it promises, for example, to have a certain amount of EBITDA relative to its debt payments. So if the bank, if any central bank lowers their interest rates, those restrictive loan payments become less constraining, if you sort of see what I mean. And if they become less constraining, as I say, that supply curve moves down. So here's the point. If the economy simply went from S to S prime, then monetary policy has an effect, and from S to S1 prime, I beg your pardon, monetary policy has an effect, and it raises investment from I to I1 prime, and that's fine. But if there are these financial accelerator effects going on, then it has an additional sort of extra effect, as it were, which lowers that supply curve, as I say, to S1, and that's the kind of amplifying effect of monetary policy. Right, so sorry for that kind of economics theory lecture. The question then is, so what about intangibles? Well, how does intangibles fit into all of this stuff? So let me try to build that up in the following way. And I think the way I think about it is that essentially this, let's do it in diagram speak, this S line is steeper for intangibles and it's flatter for tangibles, right? The fact that it's so difficult to pledge these intangibles means that these balance sheet type of constraints bite much harder for intangible firms. The fact that it's easier for the tangible firms to go along to a bank and say, here is my aircraft, here is my building, here is my office block, here are my delivery trucks, make it flatter for those firms. So in a constant interest rate world, then what happens? The intangible firms face a supply of credit, which is S1. The tangible firms face this supply of credit. The intangible firms face a supply of credit, which is SN. The tangible firms face a supply of credit, which is ST. It's an easier amount for the tangible firms. Of course, if there's just 100% credit rationing and the intangible firms, or indeed the tangible firms, can't borrow at all, then they face a supply of credit, which is that green line. Okay, the only thing they can do, they can't borrow anything at all, so they can only raise from their internal funds. So I'm not going to do that extreme kind of green line. I'm going to assume that I'd say there are these slope lines. And so that tells you, absent interest rate changes, what does it say? It tells you that in equilibrium, like firms, the intangible firms are going to face a higher price for their credit. So that's the higher line there, RN. The tangible firms are going to face a lower price for their credit. And in equilibrium, the intangible firms are going to be doing less, and the tangible firms are going to be doing more. So what's then the response to monetary policy? So now I put all this together, and I'll do some evidence in just a second. What monetary policy, when the monetary authorities lower their rates, then the two things happen, which I just said. The first thing is the horizontal bit of the line comes down, and the second bit is the sloping bit of the line both change, and they both change in their slope. So is there more or less effect in a more or less intangible economy? Well, it sort of depends a bit on the convexity of the slope. So it's somewhat of an empirical matter. You can see both of the effects are going to be magnified. The magnification, as I say, depends upon the extent to which the slope moves in and out. So what evidence do we have then about whether an intangible economy faces a different set of circumstances? And if so, what would we do about it? So back to this Della Riccia paper, which I think is a very, very interesting paper. The title is there and the link hopefully should work. As I mentioned, they have a very, I don't know how they've done it. It's very inventive. They've got this long run of loan level data, 1990 to 2016 for US banks. So they know the loan, and they know, amazingly, the bank as well. And then they've matched that, I think, to information about the firm. And then they find a number of, I think, quite interesting things, which are on the screen there for you. So the first is, guess what? The more intangible firms have a smaller number of loans, controlling for all the various other things they can control for. The loans are more expensive. So that's exactly what we saw in the various slopes. And in fact, they seem to be shorter maturity as well. So that's one thing. And then the second thing is, under the heading of banks, because they can match the loan level with the bank data, what they can tell is that the banks who are busy making these intangible loans, for every dollar of intangible loans, they're making $2 of real estate loans. So that's why there's been this sort of change in the overall composition towards more real estate. That's the first thing. And then the second thing, which I think is sort of fascinating from a sort of financial stability point of view, not a committee that I sit on, but nonetheless I will opine, I think this is very interesting, is that because you can match the loans to the banks, it turns out that if you look at the what they call the weaker banks, who I think I can't remember the exact definition, I think it's that they're less, they've got less capital and there's just less backing in general to those banks, maybe they're a bit smaller, they make even worse quality loans to intangible firms. So the one thing you do not want is you don't want an economy full up with intangible firms and full up with very weak banks. The capital conditions for that are going to be absolutely poisonous. So I thought that was kind of interesting. The next question then is, well, what are the reactions then of an intangible intensive economy to all the various changes in rates and so forth? And how else do these various loan terms and so forth work themselves out? So here I'm going to talk about some work that was very kindly done by colleagues at the Bank of England, who do something incredibly, in my view, incredibly clever and in the British context, I think very important, which is this, is if you go to the company accounts data, you can collect all the company accounts and all the clever software writers in the room know how to do that better than me. But then, of course, you know from the company accounts data the identity of the company director. You can then go to the land registry and you work out the value of the house owned by the company director, right? So that's a very clever piece of matching, which takes some fantastic technology. So you can match what the company's doing to the value of their house. Now, for the non-British people, you should understand that discussions of house prices in the UK are like house prices have been going mad in the UK, over all of these years. So this is constant dinner party conversation about the appreciation of the house. But house prices can go up 7-8%, for years and years and years, and a few years of that, and pretty soon we're talking about real money. So this is a salient issue in the UK. So if you do all of that, you then do the following regression, which again, apologies to those people who aren't familiar with regressions, but let me try and explain it in an intuitive way. You look at the investment of the firm, and you ask the question, how much does the investment of the firm change when the company director's house value goes up by £1, right? You also know the value of the corporate real estate, so you know how many buildings and so forth. So how much does it change if the value of the corporate real estate goes up by £1? And the answer over on the right-hand side is split out by tangibles and intangibles. So if you are in a, let's go over to the right, if you're in a tangible intensive firm, the answer is that if your company director's house goes up by £1, there's 4p more investment. If you're in an intangible intensive firm, that's over on the right. If you're in a tangible intensive firm, that's over on the left. It's also true that your investment goes up when the company director's house value goes up, but it only goes up by 2p. In other words, it looks like the value of the house matters much more for these intangible intensive firms relative to the tangible intensive firms, which suggests to me at least that all these various constraints about borrowing and all the difficulties from the loan level data, that's another way of seeing that if you're an intangible intensive firm, you've got to go to the only tangible asset you might have, which would be, in this case, your house. Now, the effects, therefore, of monetary policy are a bit more complicated. And so here's a complicated, slightly inconclusive regression, which runs the regression of changes in firm employment to changes in monetary policy, measured in a particularly sharp way, and asks, is monetary policy more or less sensitive if you're an intangible intensive firm or a tangible intensive firm? And the answer is that upper line there seems to be that it's a bit more sensitive for the intangible intensive firms, right? The statistical significance of these things different. They're not that different, but the point estimate looks like the intangible intensive firms are more sensitive to monetary policy. That said, I think this is an open area. There's a new paper by Dotling and Ratnowski, which finds the opposite for mostly US large firms, that actually these large firms seem to be, the intangible firms seem to be less sensitive. But equally, Anne Duval and Sever, who've got firm level data for a large number of countries, they find that if anything, there is more sensitivity, and that over the financial crisis, the central banks who were more aggressive when they cut rates had more of an effect of helping those intangible intensive firms. So I think lots of things to think through there, and there are those different findings, as I say, sometimes different data sets and different contexts. And so on. Let me just say a couple of words about the Phillips curve. I showed that graph earlier on, and this is a cross-country study by Lau and Zhang. So let me just scroll on and tell you what it is that they do. They essentially run these cross-country regressions, and then they take out the slope of the Phillips curve and ask the question, does that vary with openness, various other variables? One of their variables, of course, being intangible investment. And again, I'm sorry that's come out rather small, but essentially the message is, if you've got a more intangible intensive economy, you have a flatter Phillips curve. Now, there are all manner of identification issues around the Phillips curve and so forth, so we could spend a whole couple of days on all of that. But this is just a little bit of evidence, I think, kind of causing one to maybe have a bit of a think in this direction. I'll say something about spreads before I finish off with COVID. So something about spreads, I mentioned this spread issue here, that the spread seems to have gone up. And maybe one thought behind that is, well, if these intangibles are more risky, they're more difficult to secure against, all the stuff we saw just a second ago. Maybe the spread, the equilibrium spread over the safe assets has gone up, because if they're more risky and the safe asset is this, I've got a spread over that. And maybe therefore the increased intangible intensivity might be part of that reason. So one test of that is to look across different countries, to the extent that different countries have got their own sort of country-specific capital markets. That may not be true because everything might be mobile, but to the extent they do, what you'd hope then is the more intangible intensive countries would have the bigger spreads, and the less intangible would have the smaller spreads. And that's actually what you see. There's a scatter over on the right-hand side composed of lots of different points. And this is, again, the spread over the safe rate on the vertical axis, I'm so sorry. And you can see that's rising with the intangible intensity of the country. So I have found thinking about these intangible issues kind of helpful for thinking about, as I say, the general background of macro policy. Rebecca, I'm looking at the clock, so I'll try not to be too long. So let me say something about COVID and intangibles next. Where does the COVID shock leave the intangibles research and measurement problem? Have we all, we've all spent all this effort inspired by Corrado, Holton, Sickle, Dan Sickle is sitting over there, and various others. Maybe COVID is going to wash all that away and we've got to start doing something else. Now, clearly some very important areas are going to be, as it says on the screen, the market for health, labor markets, financial markets, enormous challenges, not only of research, but the measurement community who are represented here have got tremendous measurement problems, especially around health, when people are doing stuff on telemedicine and all that kind of thing. Where does that leave intangibles? So you'll not be surprised to know that I think intangibles are going to be even more important. So why do I say that? So the first thing is of course the COVID shock was a sectoral shock, and it's worth exploring the differences between the sectors. So here's some data from the decision maker panel. Paul Meisen sitting over there is working on the decision maker panel with Bank of England colleagues and a little bit in conjunction with ONS as well. And you'll know from that that the number of people, so the top graph is accommodation and food. The yellow part is those people who are working from home in accommodation food. The blue part is those people who are furloughed. The bottom is information and communications. And as you can see, the yellow part is enormous for information and communications. That's like newspapers and software writing and all that. All those people are writing from home, working from home, sorry. And then the number of people furloughed is rather lower. So obviously the shock is very different across those two different sectors. And so if we put our sort of policy hat on and say, well, what are we going to do about the productivity problem? Well, it's going to be something to do with innovation. So what handles are we going to pull as policymakers about innovation when it comes to thinking about these individual sectors? And the handle that at least many British policymakers go for, quite understandably, is R&D and patents and all of those traditional types of measures. So let's look at that a little bit. And so here I've used, so Josh Martin is sitting in the audience somewhere. Where is Josh? Is sitting over here. So here I've used Josh Martin and his colleagues' work, who've put together this UK experimental intangible investment data. It's broken down by the individual industries, so that's each of the horizontal lines. And then it's broken down by the assets that Carol and Chuck and Dan have told us to look at. The first column is R&D. And as I say, if you put your R&D hat on and say, oh, well, we need to start thinking about R&D and tax credits and blah, 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 but then ask the question, what are those affected sectors? They're the ones in red. How much R&D are they doing? Let's have a look at accommodation and food. Well, they're not doing any R&D. Let's look at arts, recreation, and other services. Well, they're doing 2% of R&D. So those levers may be very good levers to pull. It might indeed be that there are horrible market failures in R&D, which good government bodies can do lots of things about. I'm not saying that's not the case, but if we want to worry about these particular sectors, they're not really doing any R&D. So maybe we want to look elsewhere. And so therefore, you can see where I'm going on this. If I now highlight the red sectors, the accommodation and food and so forth, what are they doing? They're doing the menu of non-national accounts intangibles that are over there on the right-hand side. So wholesale and retail are doing tons and tons of software. They're doing lots of organizational capital as well. Arts and recreation are doing plenty of branding and training and so forth as well. So again, I think in terms of the policy effort, thinking about especially the non-national accounts intangibles really helps you think about those types of issues. Now, another point about investment, and this was mentioned a little bit by Gavin Wallace in his discussion earlier on today, is that the behavior of investment over COVID has actually been rather interestingly different between the tangibles and the intangibles. So here's a graph here. This is a real investment on a rolling average. The top dark line is investment in IPP, intellectual property products, software, artistic originals, and so forth. The bottom purple line is transport, ICT, the more sort of tangible stuff. So a couple of things you see. The first, for people not from the UK, you might say, hold on a moment, hasn't that tangible investment been dropping like a stone before COVID? So the vertical line is COVID. Well, it's been falling around about the middle of 2017, and guess what? That all corresponds with Brexit. So there's a Brexit effect going on there for people who are wondering where that's coming from. But you can see that around the time of COVID, that investment line fell very strongly, whereas the IPP line has stayed rather higher. Now, all the measurement community in this room are going to leap up and down and say, oh, it's very difficult to measure this stuff and all this, that, and the other. And maybe all of the stuff will be revised. But those differences do look quite significant differences. And so if one wants to worry about, therefore, the scarring effects that there are going to be from COVID, I think one has to take these investment lines seriously. So an exercise that I did, or I shouldn't say I did, my wonderful bank staff very kindly did for me, was the following. It's summarized up on the top left. So let me kind of walk you through what we do. So at the bank, we forecast the total amount of investment. But since we've seen quite different tangible and intangible investment, you might say, well, in that forecast, suppose we kind of mentally break that forecast out to the tangible and intangible, and then do some growth accounting work and see what's been going on and how much, therefore, scarring, that is to say, the level change in productivity might we get by 2024 on the basis of different projections. So the top line tells you that we've got some data on human capital. We've got forecasts for what human capital might be. There's been less formation of human capital, so probably we're going to have some scarring from COVID for human capital. The second line tells you, the second and third line tell you about the intangible, tangible capital. I say, if you take the bank's forecast for intangible and go back to the fact that the intangible has held up and the tangible has fallen, and sort of fit those to the bank's forecast, there are different ways you could do it, assuming rates come back up and all that kind of thing. Broadly speaking, you get a hit to productivity from tangible capital, less capital deepening. But if anything, if the intangible capital carries on going up, there might even be an increase in productivity. That would be a big call. But there's that fall in productivity is cushioned somewhat, essentially, by the fact that the intangible capital has stayed not quite as bad. And then equally, if it's got spillovers, then there might be effects from TFP. Over on the right-hand side is some work. Again, I look at Paul Meisen. The DMP survey has learnt from, again, Corrado, Holton, and Sickle, and asked questions not about all investment, but ask questions about different types of investment. And at the top, the DMP survey finds that firms are intending to invest much less in land and buildings, so that's the tangible side, but at the bottom, more in training, more in IT. So again, the dimensions of the tangible and intangible are behaving differently, and I think help one to make one's way through this. Last couple of slides. There is a correlation in this graph between intangible capital and working from home. So this tells you that the sectors who are working from home the most have got the most intangible capital. So I think if we're going to think about the future of work, then there are again some very interesting angles on the extent to which that's going to require not sort of more intangible capital around design and so forth. Okay, last slide. So let me conclude. As I've mentioned, there's some stuff here about productivity and some implications for productivity that way. I've talked about finance, the more intangible intensive firms seem to have more difficulty and so forth. And then some stuff about the future, the move to digitalization, I think is going to require intangible investment and changes in the accompanying intangible investment around organizational change and so forth. Working from home, I mentioned that as well. And the fact that intangibles have held up is, I think, very interesting. So let me end, Rebecca, finally, just by thanking everybody in this room. The work that everybody in this room has done, the conceptual work, the measurement work, the theory work, the econometrics work, has really helped me in my small world as a policymaker think through all this stuff, and it's really made a big impact. So thank you all very much. Rebecca, I'll stop there. Thank you.
Well, thank you very much for an absolutely fascinating talk. Really, really interesting to hear your thoughts about how intangibles influence the sort of broader patterns in the economy, and also how we need to maybe think differently about the effects of policy. I think that's an area that probably needs quite a lot of further work. I mean, you raised the issue that a lot of the things that arise there are actually empirical questions and require empirical analysis. So I think it confirms what everybody here probably already thinks, that measuring intangibles is super important, and also that we need to have really good quality data to be able to analyze these types of questions. So we're going to have questions from the room in here. We also have, we can also take questions from outside the room. So who would like to go first? Paul Mizzen.
Thanks very much. Really interesting talk, Jonathan, very wide ranging and really underlining the importance of intangibles. Just one comment and then one question. So relating to the different treatment of the response to tangibles as opposed to intangibles in terms of the effect of loosening monetary policy. And it's actually made worse by the fact that the fiscal authorities don't enable you to deduct intangibles from your sort of tax payments. So the annual investment allowance only refers to plant machinery and vehicles, and the super deduction policy only applies to those categories as well. So it excludes all those intangibles that could potentially be given some tax deductibility. And I suspect, therefore, that makes it even worse. The slopes of those two lines that you've shown would be different when you allow for tax deductibility. But my question then is, this makes it even more puzzling that intangible investment has held up whilst tangible has not. So I don't know if you have any comments on that.
Thanks a lot, Paul. Rebecca, should I reply or should we go around? Thanks very much, Paul. That's an interesting thought on the tax side about the various slopes of the lines. I've got to be careful. It's written into my contract that I'm not allowed to say anything about fiscal policy. And if my press officer is watching this, he'll murder me. So if I do, so I'll leave that comment on fiscal policy to you, Paul. I think it is a fascinating question about why the intangible thing has held up. Maybe there are more adjustment costs. Maybe there are more forward-looking firms. Maybe it's a sort of sorting issue that firms have got to look at that. But I mean, a very interesting question to which we need to know more answers. As I say, I think in fairness to the ONS people, I mean, I ought to say this is very difficult to measure, and I know there will be revisions and so forth. So I don't want to read too much into all of this. Nonetheless, the wedge between the lines does seem very large to me.
I've got a question from Martin.
Martin.
Thank you very much, Jonathan, for an absolutely fascinating talk. I suppose I couldn't avoid reacting to your observation that intangible investment has held up during the epidemic while tangible investment hasn't, because of course the same thing happened during the global financial crisis. And it's a bit hard to argue that that did productivity a lot of good.
So that's fair, Martin. But of course, the nature of the economy may well be changing in the future if we're moving to a more digitalized, more online world, and so forth. So you're right. I'm not saying we're going to have some productivity breakthrough, but maybe it cushions these effects relative to what they might be.
Hello, Jonathan. Christoph Weiss, European Investment Bank. You had this fascinating graph based on the survey of Paul, where you were showing 5 different categories, and we see an increase in software, but also in training. So we at the EIB run a similar survey covering 29 countries, including the US, the UK, and all the EU member states. And we have an additional category, which is called organizational and business process investment.
Okay.
And what we see as a response to COVID-19, because we did ask a very similar question, even though we didn't coordinate, but we see a massive increase in software and data, but also in organizational and business process improvement, presumably also related to working arrangement during the pandemic. So we're very much in line with the results for the UK, but organization capital is also something to be kept in mind.
Yeah, thanks very much, Christoph. I mean, that's a really interesting observation, and makes me wonder whether, when we part of the reason why this whole intangible literature got going is when we first had the ICT revolution. I think we realized as a sort of measurement and theory community that there needed to be lots of complementary investment in business processes and new ways of designing the business and so forth. Maybe if we're going to start working from home, we need another wave of that as well. So that speaks precisely to your question, Christoph, that the investment bank are looking at. Maybe we're going to need some more organizational design and more of those types of co-investment as well in order to manage people working from home and all that sort of stuff. So there could be another burst of that on the way, which of course, if we don't measure, would show up as negative TFP, etc.
We have a question from Joe Bryce.
Thank you very much. I'm not sure if I'm seeking economic wisdom or whether I'm actually after some psychotherapy, but I'll explain what I mean by that. The UK productivity slowdown, which interests me, I think is incredibly important. It's very stylized. Productivity growth, Nick Alton, I think, has shown this very convincingly, scarcely fell off at all, if at all, up until 2007, and had been growing 2.5% for the best part of 150 years. 2007 onwards, you get a complete cliff edge, virtually no growth, and still no growth. 14 years on now. So big effect equal to, I think, productivity gap estimates, ONS would say, getting on for 25% of GDP. So we're talking large amounts of money. The problem is that using intangibles as an explanation of this, except on the most extreme assumptions, gives you only a marginal contribution to the explanation. You produced a bit of evidence to suggest there is some explanatory power, but I wonder if you'd agree, actually, it's got to be pretty marginal in the context of that overall 25% gap. And then just a little bit more generally, and this is where the psychotherapy comes in. I've been struck over the last couple of days, indeed more generally, Leonard Nakamura telling us quite rightly that we live in a world of an ocean of rising knowledge, or a rising ocean of knowledge, one of the two, and we clearly do, knowledge economy world. And yet we've had, not just in the UK, but across the world, productivity stagnation. How do those fit together, and what's going on? What's the resolution of my schizophrenia?
Thanks, Joe. I think the challenge is, so I take the Nick Alton calculations. The challenge, it seems to me, is to explain why TFP has slowed down so much. Indeed. So there's absolutely been a sharp slowdown in capital deepening, but there's also been a sharp slowdown in TFP. So we need some sort of mechanism, it seems to me, which tells us why TFP has slowed down, which precisely leads to your second issue, which is Leonard sitting over there. As Leonard's taught us, if we've got this ocean of knowledge, why isn't TFP sort of zooming along? So that's why I think there is some part of the story about how the fact that we had fairly robust intangible investment before, and then that's fallen off. That would fit in the economic characteristics of intangibles, showing spillovers and so forth, but it would fit in with some notion about that would slow down TFP. We can, if we did some more econometrics, we could argue about the various effects. The challenge to all of that then is to ask the question, well, if that's, well, first of all, is that true? And, you know, data and all that kind of thing. If that is true, what was it that caused the slowdown in that intangible investment? And I think that's why I personally have become interested in these financial difficulties and the difficulty of borrowing and so forth. And maybe we've just reached the end of the road in terms of the ability of traditional financial structures to deliver intangible investment. If we can't secure these things, if venture capital can't scale up sufficiently, then, as I say, we've reached this sort of tipping point where these institutions just simply aren't good enough to support the next trip to the next sort of transition to getting more intangible capital investment. So that would be my sketch of a story.
Okay, I think we're going to take a question from Mariana Pazzi.
My question, we are now, you know, in actually entering a new era and hopefully solving the climate catastrophe, which is we are facing if we go like this. So the issue of green transition, which will demand lots of investment, all types of investment, but it will be, at least we think, it is innovation and technology based and research based. So how do you see the role of different type of intangibles in that transition? I think it will look a little bit different than here. You know, research and development is so low, and I guess that basic research and research technologies are in the front, but of course the others have to.
So Marianne, I mean, I think that's a really good question, and one's instinct as an intangible person is that, as you say, there's got to be some new ideas and some new ways of improving the technology and so forth. If I had to nail down which of the various headings it's going to come under, I'd have to sort of think more about that. Maybe this is an area where it's just, there's just a big role for the public sector.
That's my plea.
I mean, maybe this is an area where there's a big role for the public sector, actually, and that the synergies which we seem to see between public sector intangible investment and private sector intangible investment might turn out to be very important here. I mean, maybe that's something for the next panel, I don't know, but very good question.
Question from the gentleman in the second row here.
Thanks. Phil Aldrich at Bloomberg News. At the risk of straying close to the off-limits subject matter, you mentioned R-star at the start of the, and this being a contributory factor to some of the problems that you're identifying. Would one of the solutions to that possibly be a higher inflation rate to try and give more monetary policy headroom? And the stuff, and your comments about the institutional problems with investment in intangibles, is the Financial Policy Committee and also financial regulation here culpable because you have these high capital requirements against intangibles, and as you were pointing out, like business owners are having to put their property up as collateral because you know, that lowers the cost of capital for the banks, etc. So it does come back to a policy issue which could rest at Threadneedle Street or, you know.
Okay. Thanks, Phil. You'll forgive me. I'm going to be a little bit evasive there. The issue about the issue about the target and so forth is not for us on the committee, as you know, that, you know, that's for the government. On the issues about sort of financing and so forth, I mean, I think the trouble is they're probably quite deep-seated. So because we've got this rather peculiar system in the UK where pension funds are linked to companies as opposed to being more general, we've got lots and lots and lots of sort of little pension funds. And so for them, and many of which are closing, of course, as these very generous final salary schemes close. So the incentives for pension funds, if you've got a little pension fund and they've got to do a lot of monitoring of these intangible intensive companies with complicated business models and all that kind of thing, it's very difficult for them to do that. So I suspect quite apart from what the Financial Policy Committee, not my committee, can or can't do, there are these very deep-seated problems as well, which will have to be got over.
Thank you. So we have a question from Anthony Savagar.
Thanks for your talk, Jonathan. Anthony Savagar, University of Kent. So my question is just to do with the pledgeability of different types of capital and how much you think that could be driving differences between intangible and tangible intensive industries. If you were to relax that constraint of not being able to pledge intangibles, do you think it would make a big difference? Would you see some sort of convergence in some of the differences you've seen, so the lending rates and so forth? Or is it just because banks view the intangible firms as being very risky and it wouldn't change much? Do you think it's something that bites is the question, really?
So I mean, I think it does bite. And I think what's sort of interesting about all of this, Anthony, so thanks for the question, is if you take these financial accelerator types of models, because you've got this sort of amplification effect going on, one of the things that loose monetary policy can do is it can loosen these constraints. And for the intangible intensive firms, that might turn out to be very important. But I think where your question then takes you is, well, suppose we had a world with a lot of all this intangible capital being pledged, banks are holding on to all this stuff, would that all be very risky and so forth, which takes back to Phil Aldrich's nice question about what's the role then of the Financial Policy Committee and banking stability and all that sort of stuff. And we don't know the answer to that.
Thank you very much.
Thanks, Anthony.
We have a question from Leonard Nakamura.
Well, this is really more a comment than a question, but I want to respond about the green financing issue. And one of the big things that we need to do is, have a lot of innovation in green intangibles. And now we have an economy that has, what, 15% of its, all of its economic activity in intangibles already. So now, and we think we're getting very little productivity out of that, and that it's a shame that this is leveled off. But yet, it's possible that, as I think, that mismeasurement means that we're, in fact, being very productive. But it's also possible that I'm wrong, that we're able to be, that we're investing a tremendous amount of stuff in innovation and not getting anywhere. So, but either way, I would argue we can afford to shift some of this intangible activity towards the most important social benefit that we can imagine right now. So I would really support, a public, redirection of innovation towards green areas.
So if I can respond to that, Leonard, very quickly. I mean, absolutely. And as I mentioned before, I just wonder whether this is an area where the public sector investment is going to be really important. Some private sector investments for green R&D are very strong, but I can imagine some companies who don't have a very strong, incentive to make private investment as well. So this may be an area where the public sector, there's enough market failure that the public sector are going to play a very important role here as well.
Okay, so we have a question from Sanjeev Mahajan, who is listening in at home or not in this room. So he has a few things here, so I'll read out some of them. So related to what you were saying earlier about house prices, he's saying, the value of the house is separate from the value of the land, and should there be a better focus on land prices rather than buildings? And also whether you have any thoughts on a change in trend in financing, switching from domestic to international providers, including the shift of IP.
A change, so sorry, Rebecca.
So Sanjeev is saying that whether you have any thoughts on the change in trend in financing, switching from domestic to international providers, including the shift in IP.
I see. Thanks, Sanjeev, for those questions. Yes, I'm aware that there are horrible national income accounting problems about land prices and house prices and so forth as well. And then hence that takes one into an issue about RPI and CPI and the correct incorporation of housing prices into the various indices and so forth. So that is a whole bag of worms, can of worms, which is going to need a concerted effort to deal with. On the move to more international finance, I guess an interesting question there, which I don't know the answer to, is the extent to which in these studies one could distinguish between domestic banks, foreign banks, and international banks. And that maybe would nail down Sanjeev's very legitimate question about whether, you know, there might be a relaxation of these constraints if we had more foreign banks, better capitalized, or whatever it might be. So it's a very interesting question. I don't know the answer to that.
I think we have time for one final question from Hannu Piekula.
Thank you. I would like to participate into the lectures at the university sometimes. This is very interesting what you are teaching to us right now. So I think large part of the intangible intensive country firms are profitable. So they don't need lending. So there's a regime of intangible intensive sectors and firms that are faced with a financial challenge. And then you have the question what happens when it's more easy to get loans. But it seems to be, if I think about the Finland and my calculations, the intangibles seems to be as productive as before. So there's a very positive effect on markups, technical change continues on when you use firm level data, even through the COVID period and also after the financial crisis. So much of the problem in Finland was massive misallocation of tangible capital. So we are a very capital intensive country, and before financial crisis, they try to keep their profit rates high by investing in wrong machinery, massive errors in tangible investment. And these distortions that you describe here make even stronger because of some intangibles. Firms cannot get the finance, and these old stylish firms still try to survive. So there's a decrease in tangible investment, also massive misallocation of tangible investment into wrong sectors, which are not productive in the future. And very few studies show that, but there must be this, there is no creative destruction because of this massive support that we've received. So I mean, most of the intangible sector are healthy because they're profitable, and maybe it's only part make the mess, and then it's a tangible investment which are very much misallocated nowadays to wrong sectors because of these low interest rates.
So thanks, Hannu. And you know, like me, I'm sure many people in the room have learned from your Innov Drive work that you've done in that particular group. I just wanted to say that. I think one theme which comes out of that, I think, is if you ask the question, are Apple and Google and these superstar firms, Amazon, are they really constrained by all these various graphs? The answer is no, they're sitting on enormous amounts of cash. They've got more cash than most banks. So I would regard those kind of superstar firms as being in a different regime to the types of constraints that I've been talking about before. So unraveling how all the various constraints bite, taking into account all of those different firms is a big question. But as I said, I would separate those out just a little bit from what I've been saying.
Okay, well, I think we can draw this session to a close. Thank you very much, Jonathan, for the excellent talk and for taking all of these questions.
All right, thank you very much.